And welcome to the Real Estate Breakfast Series. My name is Jeanette Weiland, and I'm the Vice President of Bio, Innovation, and Special Projects for the New Orleans Business Alliance. I want to thank you for being in attendance this morning, as well as thank our partner, the Urban Land Institute of Louisiana, for helping us put this event on today. NOLABA is committed to bringing you worthwhile and meaningful content to give you ideas to move forward in whatever business endeavors you're engaged in. We strive to bring experts and topics to the table that will help you enhance and grow your businesses. And with that in mind, we have with us today Dr. Jesse Keenan, Associate Professor of Real Estate at Tulane University, and Mr. Chip Gardner, Vice President of Operations for Latter & Bloom. So welcome, Dr. Keenan and Chip. Thank you for being with us today. And to get us started, I want to go ahead and give you some space to introduce yourselves. You both have very impressive and, quite frankly, diverse and complementary backgrounds. Chip, do you want to start?
Yeah, sure. So Chip Gardner, I come from the Gardner real estate family of New Orleans. My great-grandmother was Gertrude Gardner, and she ran her own business for the first 78 years of her life. And then recently, big news in the city, our family, my great-grandmother started her business at Latter & Bloom, broke off on her own, and 78 years later, we came back and joined the Latter & Bloom family. So it's been truly a marriage of the top two local real estate families. I'm excited to be here. Just something about me personally, I've been back in New Orleans for the last decade full time. Prior to that, not a lot of people realize, but I worked based out of Houston for an investment bank for value, advising Fortune 500 companies, pension funds, REITs. I did work all over the country in all parts of the world as well. And I hold the MAI designation. So I have a background in commercial while I've lived in the residential real estate space the last decade and still play it in its own.
That's fantastic. Yes, it sounds like this role for you today is a great culmination of all that experience. I'm sure you look back and think, I never knew I would pull on this experience today.
It's all led to this moment.
Yes. And you, Dr. Keenan, do you want to go ahead and give the audience some background about yourself?
Sure, I'm Jesse Keenan. I just moved to New Orleans last week, believe it or not. I'm Associate Professor of Real Estate at Tulane. I also came from a matriarchal real estate family. Actually, my grandmother was in real estate, and that really, I think, inspired me as a young person. But prior to moving here, I was the head of real estate, director of the program at Harvard, Graduate School of Design and Real Estate. And prior to that, I spent a decade in New York running a real estate center and research at Columbia University. So I've worked all around the world, working with governors and CEOs and presidents on cities, economic development, housing, real estate, and most of my work these days focuses on climate change and the global financial sector.
Oh my goodness, I had no idea that you two had so much in common. So this is even more fun. So both of your grandmothers, or Chip, did you say great-grandmother or grandmother?
Great-grandmother. I'm the fourth generation.
Yeah. Yes, good for you. Okay, this is exciting. And then Jesse, you left out the part, did you not live in Miami as well? Because you know about seersucker suits. So.
I did. I lived in Miami for a good number of years, and it's where I got started my career in real estate.
Awesome. Wonderful. And just because of that, I wore one for you today. Not that you can see it, but you inspired me. So to dive right in, Chip, do you want to go ahead and start? I think it would be great to just give the audience your perspective on the current local market in New Orleans, yep. Residential, commercial, what's happening, what's hot, what's not, anything you want to add.
All right. Awesome. Well, let's jump right in. So right now we know in the residential world, okay, it's a very exciting time. Okay. I mean, it shouldn't be a surprise to anyone, just what I call the velocity of the marketplace. So if we're talking about, just greater New Orleans, right now, we are absolutely in a seller's market. Okay. We have 1.3 months of inventory based upon closed sales. This is a historic low
Chip Gardner
for our market.
One of the oldest real estate families in New Orleans.
Yeah. All right, there we go. Someone chiming in. But we are at a historic low locally, and New Orleans is in line with national trends right now with that, right? A lot of times we beat to our own drum here, but nationally we're at historic lows, okay? So when it comes to like jumping into this, what does the 1.3 months of inventory based on closed sales really mean? Well, this time today compared to this time last year, our inventory is half of what it was, okay? we're basically 4,500 units. We're at 2,250 today, right? It's essentially half. Our number of closings, 12, comparing the most recent 12 months to the prior 12, we're up 26% across the greater market area. With that, our days on market have dropped to just under 50% or half of what it used to be this time last year, right? Those are all positive trends. We've experienced on an overall level about double-digit appreciation as well. So all of these, when I say the greater New Orleans marketplace, I'm talking about the 10 parish region in Southeast Louisiana that constitutes it. But when I look at the data on a parish by parish level and segment it from there, I can tell you it is all positive across. And that is not the case most times. There's usually, sub-markets, this and that, but it's generally all positive indicators all the way down. But what I can tell you is when we look at specifically where are some of the biggest gains, the top gainer right now when looking at closed sales is St. Tammany Parish. St. Tammany Parish is up 1,650 units over 12 months compared to the prior 12, which is about a 34% increase. And that's followed by Orleans and Jefferson Parish, right? With the greatest number of units for that change. So that kind of sums it up. And then let me leave you with this. Also on the residential side, overall marketplace, if we're talking about inventory of less than, say, $250,000, there's not even a month of inventory. It's less than a month. If we're talking luxury for our marketplace, which I generally use the rule of top 10% of the overall market, 800,000 and above, we're looking at about 4.5 months of inventory or neutral market, which is good for our marketplace. So, but once again, all positive indicators, St. Tammany, Orleans, and Jefferson leading the way. Now, when we shift into the commercial side, which is some of the growth areas, right? When I just look at some of the things that have happened even in mid-city on the Lafitte Greenway, right? When we looked at just the redevelopment that's happened there with multifamily, with retail, now we're hearing about the potential even further expansion of it into Lakeview, right? All the way down to the municipal auditorium. That's another just one where it's not just that mid-city part that's going to keep spurring along the Greenway. It's really going to go the full, all the way from Lakeview down to the municipal auditorium. So that's definitely a growth corridor, something to watch out for the future, right? But that hasn't been on people's maps, but it's not fully there. It's just really getting started, in my opinion. The next thing is just look at what's going on downtown right now, right? Because, we had a lot of projects that paused, okay? Now, in some cities, once things pause, they don't necessarily turn back on online. So I'm calling growth, although it started let's just say pandemic, because it's positive to see things like the Four Seasons and the Virgin Hotel get to the finish line, right? And didn't just stay in a pause condition. So to me, those are very exciting things that just show the growth. And it's nice to see the growth back in the urban core, like at this point in time.
Thank you. That was very interesting. Before I jump over to Dr. Keenan, I'm curious. So with all those stats and data that you have, and knowing that probably there's plenty of like physical space that's not developed in St. Tammany Parish, as well as parts of New Orleans, for instance, like the East that never came back.
Yeah.
Do you have predictions on the residential side? Well, maybe both, maybe residential and commercial. Do you think that we'll see more supply coming online, or are the cost of construction, the rising cost of construction, going to kind of counteract that natural tendency? What do you think?
All right. Well, predictions can be dangerous. No, that's
I know.
but no, this is one I'm very happy to answer. Let me start on the residential side. On the residential side, the areas that are going to be the winners for growth are the ones that can develop the product that people need that's affordable, right? Let's just say 300,000 and below. Okay. If that's where we have the shortest amount of inventory, and this isn't a new problem, right? It's something that we've continued to have. One thing that I will say, I think that is going to be different that's coming out of COVID, right? If we tie it, is I think people are willing to drive further distances now, right? Than what they were used to. So my prediction is whoever can develop product for 300,000 below that meet the features and amenity with square footage that people want, those are going to be the winning areas, right? We've heard about some of it in St. Bernard and Araby. That's been a hot area as of late, right? Where that wasn't on some people's roadmaps a few years ago, right? St. Tammany Parish, absolutely. The East can do that with the cost of land. One of the biggest things for us on the residential side is, closer to the urban core in Orleans, is just the cost of land, right? So we do have to move further out in times, unless it's an infill area or less popular area, just to be able to achieve affordable dirt so that a developer or investor can go in there and create a product that meets that side without some type of government subsidy, just talking sheer private sector money flowing in and creating that product. But, if we can build new product that meets the features that people want at 250, 275, they're going to buy it all day. And those areas are going to experience the growth. And yes, some of that is definitely going to be in St. Tammany Parish.
Good to know. Thank you. Dr. Keenan, because of your vast experience in terms of research and looking at multiple markets and such, considering all the comments that Mr. Gardner just gave us, do you have any, and again, I know no one has a crystal ball, but any commentary or predictions for New Orleans?
A quick follow-up, and let me also acknowledge, I moved here last week, so take this all with a grain of salt and take it as a perspective of an outsider who's looked in of New Orleans and the metro area, among other cities in the United States. I think there's a few interesting things that Chip brought up. And I think it is worth starting in highlighting the underlying stability of commercial office, particularly in New Orleans.
Yeah.
It's quite affordable here. You're talking about rollover on leases and new lease ups, sub 20 a square foot, which is extremely competitive. And there's a lot of Class A, and I kind of question the extent to which Class A really qualifies as Class A for some of the out-of-towners, if you will. But the numbers are stable, and if you start looking at occupancy rates, and the occupancy is pretty good. Now, it's always a lagging indicator, but if I'm a special servicer looking at some CMBS debt, non-hospitality, but just looking at office or just looking at debt in general, I'm feeling pretty good, satisfied. And in part because much of the lease-up space in New Orleans is pretty small.
Yeah,
I'm talking about less than 20,000 square feet on most lease deals, probably in the 12, 13,000 on average, would be my guess, just looking at the raw data. So I think that the office market actually has benefited just from not a lot of supply, right? Just like the residential sector, supply drives some measure of stability in office, and that's quite a positive thing. I can't speak to the outer parishes, but I think at its core, it's much more stable than many other markets in the United States. So that's quite a positive thing. It's a good thing for landlords. The other thing on the outer parish residential development, and I do think preferences are changing in terms of housing demand, investment classes. I mean, how and where people work, and transportation, as Chip cited, is certainly one metric. I think there's another element here, and this is the cycle of crime. And as criminal activity, and crime always operates in cycles and in waves, but that will no doubt push some people out to the parishes. And when you start looking at other constraints associated with transportation, such as streets and street paving and the quality. I mean, I just moved here; the streets are terrible, so. I can only imagine the advantages that some of the other parishes have in terms of fundamental infrastructure. So, the cost of land may be the ultimate economic determinant of relative affordability for new housing production. But once you start imputing some of those costs relative to your tax burden in terms of infrastructure and new development, this is where the parishes really operate at scale to a competitive advantage. And this has been a story in New Orleans for decades, but I think we're really at a point where it becomes amplified. The question is, in this greenfield development, what's your underlying capacity to support that adequately with infrastructure? I think that's to be determined.
Thank you, Dr. Keenan. And to piggyback on those comments, in your research and in your experience in other markets, have you ever seen what types of policy have you seen enacted, or community activities and behaviors have you seen that can really stop a trend, a negative trend, so to speak? So if a community has no or very little control over the pothole situation, what can people do? What can people do? What can leadership do? What can policy do? What are some ideas that you've seen work in other places that might be able to be considered for New Orleans?
Well, there's a couple of different ways to approach this question. It depends on who your stakeholders are, but this is a convening today of ULI and real estate and your economic development organization. So let's talk in terms of what it means to work together as a community of allied professionals and business leaders. And I think, the extent to which you can exert influence over a vision for what you want the city to be and where you want development to go and how you want it to look like, I think is critically important. In some level, it looks like external communications. right? And it's a kind of engagement mechanism. And who knows if something gets master plan, right? But the real value is that it brings and helps build a consensus. And people across the political spectrum, we all have common interests. And our common interests are stability and prosperity, right? Actually, it's right behind you. You can read it. Culture, equity, prosperity. That's our common interest. And I think if we have a vision, and a vision that we can understand where things are going to go and where we want them to go, and we can communicate that and work collaboratively, you're much better off. In cities that do that, on like New York City, for instance, or Washington D.C., they are much more in tune with pushing government, local government in particular, to help be a partner in guiding development in the right direction. You look at another city like Miami where they don't have that collaboration. And it's quite dysfunctional because of that. It's quite fragmented. And even simple things like transportation planning expenditures don't line up with the intensity of development, housing, and residential development patterns. And so if I'm an investor and I'm looking at different governance and I'm looking at the capacity of the private sector to work collaboratively, that's a critical element for envisioning where the city is going to go. Because I think New Orleans has a pretty clear development trajectory, at least in my mind, as the port relocates and you open up an entire new riverfront to development that's going to completely change the city. You need a vision for where that's going to go.
And Chip, since you have a bit more history than 1 week in New Orleans as well, so do you want to comment about how the private sector, so in the case of your brokerage firm, how does the private sector intersect with public when it comes to land use and urban planning, and does it at all, or do you think there's opportunity for something to form?
Well, anytime there's a discussion, that's good, right? Versus this is the way land use is. And I think that open discussions and dialogue and everyone working together is key in order for us to make the progress that we need to, or we all want to, right? So yeah, I mean, that's all positive.
Wonderful, thanks. If you guys don't mind, I'm going to pivot really quickly because in Dr. Keenan's introduction of himself, he mentioned his work and his focus in climate change and how that relates to real estate development. And obviously, New Orleans is ripe for that discussion as we live with water. We have not perfected living with water and managing water, but there are a lot of people working hard to do so. Dr. Keenan, do you want to give us some background about maybe the books that you've written, case studies, best practices, and kind of apply them to what you see in New Orleans? And maybe if you haven't seen New Orleans enough, or maybe Chip can jump in and kind of give his opinion as well.
Well, I don't want to turn this quickly into a lecture of the broader economy, financial economy of climate change and how that we all pay for that, sort of paradoxically as taxpayers or consumers. But let me extrapolate a little bit on how I think a few different phenomenon are going to impact New Orleans out of our pockets, right? And our NOI at the end of the day. So let's talk about that. So we have a couple of different very clear signals now in mortgage finance, both in terms of valuation, but also in terms of primary underwriting. We see both extensive and intensive marginal response by portfolio investors. And what that really means is people are changing the terms of debt. They're changing, and that may be interest rates, that may be the actual term of the debt, but they're also thinking about where to invest in binary terms, right? So we begin to see a sort of geography of risk, and people are getting much more precise analytically about the underlying nature of risk. Now, if you're a mortgage investor, there's all different types of risk, not just collateral risk, the house floods or burns down. There's risk like prepayment risk, right? Someone prepays it off early because of insurance payoff or whatever. There's all different types of underlying risk, including the degradation of value. Now, that's one end of the equation, and we see discounting in high-risk areas that are driven primarily by demand. So the buyers of real estate, particularly residential, are beginning to capitalize risk, and they're understanding a risk. And sometimes that's a misunderstanding risk. Sometimes they overestimate what the actual risk is. But more sophisticated investors in particular, and we see this in multifamily investors, are beginning to capitalize risk. That is, buyers and sellers are accepting less for higher risk properties, right? And we have the technology that helps us make more informed decisions, right? So that's happening. On the public finance side, and this is where I think New Orleans has a problem. On the public finance side, muni bond markets in particular are beginning to really both qualitatively and increasingly quantitatively understand what's at risk in terms of the capacity and credit underwriting. And when you start looking at New Orleans and you start with utilities and you work your way up, there's no way New Orleans has enough money to pay for what it needs just in terms of physical infrastructure. There's not enough money here. The state's not going to bail you out. Washington's not going to bail you out. How's it going to play out? Well, it's going to play out with significant increases in utility rates. You know, in the next decade, it wouldn't surprise me if your water and sewer bill went up 10 times. This is certainly on par with many other places in the United States. You're grossly underpaying for your capacity for water. Everybody knows this, right? Everybody intuitively knows this, but doesn't really talk about it. And the question is, where's this money going to come from? Does it come from hospitality? Does it come from pied-à-terre tax? You know, where's it really going to come? Is it going to kill the market that you thrive on, which is increasingly a second home, retiree, upper income, property tax market? It's hard to know at this point. But the bottom line economy is that the public finance situation, and listen, you've gone through this before in multiple generations. People have known since the 1870s in New Orleans that didn't have quite a diversified economy sufficient to support its own weight. But I think as we move forward, there is some significant challenges, and flooding, climate, intervening random storms, these all just impose stresses that undermine the existing capacity of infrastructure to support people's daily lives, people's daily commutes and our underlying economy.
Okay, so as a New Orleanian, I like to be solution oriented and optimistic. So what can we do? We
want to be
so we have
solution
challenges.
oriented. It's get on your hands and knees and beg Washington to give you as much infrastructure funding as you can possibly get, and to begin to essentially fill in the gaps where what we'll start with water and sewer can't sufficiently capitalize investments, and then you have to move into transportation funding as well. So it's the only principal investment mechanism, as I see it, realistically, without imposing huge regressive cost burdens on most of the population in New Orleans, is to hope that you get a pretty robust infrastructure bill here in the next couple of years.
Okay, well, I think there's a good chance of that. Chip, what are your thoughts?
Yeah, so you heard it first here. I'm not your guy with climate change, okay? But what I can add to the conversation is, on top of the positive news that we heard about water bills over the next 10 years or the next decade, one of the headwinds I do see is everything we're hearing from the insurance markets. Dr. Keenan talked about, utilities, mortgage side, but we have our own challenges in the insurance markets, right? And I'm not just talking flood. So, there's some revised flood guidelines that are beginning coming out, and it's more risk adjusted, right? So the places that are at more risk are going to pay more versus it all being normalized. Well, that's going to have some adverse effects on us because we're higher risk than the rest of the nation. Okay, so we can expect some increases there. The other thing is just in the insurance markets. When I talk to my buddies and points of contact, not just locally, but nationally in the insurance markets, they got hammered with the stuff in Texas with the freezes. The reinsurance companies, the ones that insure the insurance companies, their claims have been through the roof, right? They said, we got to recoup these losses. We're going to have a lot, whether it's your flood policies or your property and casualty, your homeowners policies, we are going to see headwinds and expect increases, probably double digits significantly, like in the commercial space, it's going to hit the commercial segment even harder. I mean, I've seen people personally experience doubles in just their insurance when their portfolios get readjusted. So, that is going to be a headwind for us in this region, but we're not just facing it alone on the property and casualty side. The rest of the country is as well.
Yeah, I mean, Chip's 100% right. Reinsurance, and particularly reinsurance losses in recent years from California, everybody else is paying for it. Now, Florida and Texas, our neighbors, they have a different situation because they have a state backstop, particularly on wind. Wind is the name of the game here, but also particularly if we're going to talk about commercial real estate, business continuity. And business continuity doesn't have the same actuarial basis as wind and flood. And that there's a lot of volatility and pricing variability in that market. And by the way, if you're talking about major corporate real estate decision making, that's a significant factor that we've seen play out in terms of location analysis. So it's TBD. But the good news on that is that there's a lot of what happens in California is going to have a lot of tailwind positively, I think, for the rest of the country as they get more accurate pricing. And as we get more accurate pricing, things should stabilize here in the next decade. So essentially, people in California and Texas are going to be paying more for insurance, and Louisiana is a very small state. So it should be able to regulate itself in a manner, at least along the regulated lines, that is, to stabilize things. But it's certainly going to impact external outside the state parties.
And forgive me if this question is completely out of left field, but now I'm just personally curious. Historically, we've never seen more than one state combine together and combine like spreading the risk of P&C or anything, correct? Like that doesn't, like Louisiana, Mississippi, is it possible?
There's some constitutional limitations, and theoretically it's possible to pool risk in that way. The insurance industry has talked about having a multi-state pooled backstop, but it doesn't really work if you're two adjoining states like Texas and Louisiana, because you both have near equal risk in terms of hurricane landfall. So it would work better if it was Minnesota and Louisiana.
Right. Got it. Okay. Spread the risk of hurricanes and snow or wildfires
and other collateral.
hurricanes.
Yeah, exactly.
Got it. Okay. That makes sense. Chip, you're making a funny face. Is there, or do you have thoughts about that? Or
Well, when I hear about like spreading the risk and stuff, like what, as you said, I have thoughts. Like I spoke in Washington, D.C. at the National Flood Insurance Conference like 3 years ago. And that was kind of like a game changer for my insight, because when you really look at how many people across the country pay into it, it's less than 10%. And there's more competition from the private sector more than ever. So in our mind, everyone has flood insurance. In the outside world, that's really not the case. And the national government's trying to do the same thing. How do we spread more risk out there? Because only people really buying are those that think they're going to flood. And, we're getting hammered on this. So it's just like, when I kind of went to DC, like, yeah, we need as much federal money as possible. Absolutely. But you realize there's not as much love about continuing to send money to certain regions. I'm not saying ours, just certain regions, because of, when they look at how much is being paid up for versus what's being collected. In the addition of the private sector, entering the market and selling policies at different rates, that's affecting things. But what the federal government's doing with some of the revised FEMA, with the flood policies, they're adopting some of the private sector technologies. It's basically been stated so that they can get more competitive on their pricing to start shrinking the gap, right? Which we all want a healthy national flood insurance program, right? So we should all be for it. But just unfortunately, one of the things that is going to come with that is high risk areas are going to increase in pricing. Now there is going to be a cap on that from what I've read so far, right? Where policies aren't going to double and triple overnight. Sometimes the last thing I read said it won't be escalations more than 18% per year. But if you don't want to 18 on top of 18 on top of 18 going in for a while, that's a possibility for some people in locations.
So flood point two, Chip's 100% right on this one, as always today. FEMA 2.0 is Bigger Waters 2.0, right? Bigger Waters is an act pact that ultimately was repealed after Hurricane Sandy because the rates went up too quickly, too fast. But the signals, even at 18% a year on an annual increase, are sufficient enough to go ahead and impact land prices.
Yep.
And land prices are already quite responsive to this because you could easily see $10,000 a year. Guess what? With $250,000 of coverage, right? So there's very limited coverage within FIP as it stands, and it'll be very interesting to see where the private market begins to fill the gap, because they're extremely selective, and in many areas they just don't offer any coverage at all. And this is increasingly going to be a problem, I think, in Louisiana with wind coverage. And I don't know how this plays out with building codes here. I need to check in on that, but wind coverage I think is going to be more and more difficult to find adequate coverage.
Yep.
Interesting. Okay, to bring it back onto a more micro level, Chip, let's go to you and talk to us about, are your brokers, are your agents seeing any major interest from national retailers? I mean, who commercially speaking, who's looking at New Orleans despite all of the risk, all of the risk in terms of business continuity and insurance prices and all that jazz? Are you seeing anything positive that we can hear about?
Hey, there's always something positive, okay? So the first thing I'm going to say, I don't want people to be like, oh, that's obvious, but we have to state it. I mean, restaurant and hospitality, national interest will continue to look in, right? We pride ourselves on being local. New Orleans, one of the greatest places to be local, right? But, what I can tell you is, while some of these national restaurant groups and hospitality groups have, they're hurting as well, right? They've made their own cuts, and they're going to be very smart and strategic in the future about where they go and plant a flag. Now, for a lot of these places, New Orleans has always been a place where they want to plant a flag, but there hasn't been the opportunity, right? Well, unfortunately, though, we can think of some restaurants that aren't here anymore, right, in prominent locations. So, these groups are still evaluating their own, issues, risk tolerance, but New Orleans is definitely going to be on the map for restaurant and hospitality groups from outside to come in to try to just say, we believe tourism's coming back, we believe conventions are coming back, and we want to have a seat at the table in New Orleans and put a flagship, store, flagship restaurant here, flagship hotel, and so that it will be a positive one, right? Additionally, with our tech niche in the city of New Orleans, which has really come about through some aggressive state, tax credits, opportunity, economic incentives. When it comes to the game and software development and testing, we continue to see that continuing to sustain momentum so long as we maintain our state economic incentives. I guess another opportunity would be I continue to see third-party logistics or distribution companies coming into this region, right? Bringing more jobs and helping that out. And, another one is medical research thanks to our new medical corridor. We're going to continue to see some outside medical research companies come in to be a part of this flagship and beautiful facility that we have.
Wonderful. Okay. And I apologize for pivoting back again, but we did have a question in the chat. I want to address it in real time since it relates to the previous discussion about insurance and such. Ms. Bordelon says, since we often have increased risk due to snow melt, is there an option there to spread risk with states in the Mississippi River Valley that don't usually flood? Has it been discussed or?
I'll just answer that and say quickly no, because the exposure profiles are entirely different. This was a system designed by Army Corps relative to agriculture and a slew of other things. So you have different asset classes, different exposure levels, and they're just not equivocal in terms of pooled insurance instrumentation. In theory, you could create derivatives and do all kinds of things, but it's not really a market from which the public can engage.
Got it. Okay, thank you. Okay, so then we'll go back, and please, everyone, if you have questions, feel free to put them in the chat. We're already at 9:37, so we don't have a ton of time left. We'd love to hear from you. It sparks great conversation. Going back to Chip's previous comments about which industries he believes are always going to have an interest and are always going to view New Orleans and our market as a hot spot. Dr. Keenan, did you have any comments about that? About diversifying the economy? Or?
I moved to New Orleans for a reason, in part because I think that there's a huge capacity here for transforming the city into a beautiful place, in a more equitable place, and one that can truly be a benchmark for the rest of the United States when it comes to historic preservation, landscape, affordable housing, et cetera. I mean, there's so much opportunity here, and so much of that's already happening, right? And so in my mind, for me, it's a huge learning process to be here. And I think if I step in the shoes of corporate real estate and corporate relocation, why would other firms want to relocate here? Well, it's cheap to live here, except for paying maybe car insurance. It's extremely cheap to live here. Housing and certain tiers of housing, both rental and for sale, is comparatively more relatively inexpensive compared to the Northeast, in particular in the Mid-Atlantic. The other part of it is who's the sort of tenant type, and what I see is actually those entities, and this aligns pretty well with the existing economic development strategies, arts, entertainment, digital media, and things like that, which are really the companies reaching into acceleration, right? They've moved out of incubation stages and they're moving into that early growth stage. And that's where you need to lease up about 20 to 30,000 square feet. And this is really an ideal place for that type of accelerator firm. And there's enough of, I would say, an agglomeration phenomenon here in terms of a skilled labor force to support that. And I think that's a critical element. There's a lot of great universities, technical training, and as well as industrial knowledge in New Orleans that can really be tapped into. So it isn't just it isn't just the office market drawing tech accelerators. It's also light industrial capacity. And warehousing space right now is tight. Cold storage space is tight. Light industrial manufacturing space is tight, but we've got that expertise and we've got that capacity, particularly within existing zoning. And I think it's really about how do we reshuffle the deck cards to make sure that we're getting that product online in a way that aligns with our existing labor force. And I think that you're going to start seeing, and this is one of the advantages of climate change, right? There's a lot of work that needs to be done in terms of the physical mechanics of product development, everything for, a huge array of things relating from navigation all the way up to land making that require a certain levels of industrial activity that are quite well positioned to be a job source and well aligned with existing land uses in the city. So I think there's a huge array of economic opportunities that aligns well with the historic capacity of the city.
So Jeanette, I'd like to jump in here. So because when we start off on the residential side, we've gone heavily commercial, but I want to take us back to residential because, we talked about where we were, but I want to talk about how we got here, right? So how are we in the seller's market? Because, I question, the range, hey, did the spike in residential happen like once the, vaccine came out, or like when did the boom start? Like they're trying to like peg it. And what I like to do is just take people back, like imagine wherever you were during lockdown, right? Like peak lockdown, like in March, okay? It was at that time that people really started to ask themselves questions in their head, whether they realized it or not, okay? People are saying, am I living where I want to live, okay? One of the other questions people ask themselves, am I living with the person I want to live with? And then some people say, am I doing what I want to do in life, right? Those are three big changes in life that affect the household and the dynamics, right? So if we start with the first one, am I living where I want to live? Let's say you were lukewarm about your house or where you lived like pre-COVID. Well, odds are by, May, June, you hated it, right? You're like, I want out, because if you were lukewarm, you definitely didn't love it. Sadly, I have friends that are divorce attorneys. I've read some articles nationally. We're going to have the highest rate of divorce and separation in this country over the next couple of years. Okay. Right. That's also had some pent up demand where just push some people over edge where they weren't happy before. They really weren't happy after. And then the third one, am I doing what I want to do in life? Right. Unfortunately, some people lost their jobs during cutbacks during pandemic. Right. But other people just said, you know what? I'm reflecting. I'm not happy in life. I'm not happy where I'm living. I'm not happy at my job. Some people just picked up and moved. Some people just said, I'm going to find a new job. Right. And all these things are shift in the residential dynamics that have caused people to buy and sell properties, right? So when people say, when did this start? Well, it basically started late spring with this pent up demand, because for a period of time, although like our marketplace, we were deemed an essential service, we were limited. And like a company like us always had the technology to service clients, and we were doing a lot of deals during that time period. But then as people got more comfortable letting people into their house, if the house was occupied and people felt more comfortable going out, the surge and the momentum began late last spring. And it hasn't slowed down since, right? So the typical New Orleans real estate economy, we slow down Thanksgiving, Christmas, and there's a lull till Mardi Gras. Well, guess what? We had no Mardi Gras. The business stayed constant. So like a lot of people don't think we didn't have the lulls on the residential side that we typically do. Inventories, I went over literally month over month, kept having declines as closings in the moon kept happening. So this is for real and happening. Now, the other thing that's really interesting on the residential side is the shift in consumer taste and preferences. I'm sure everyone's read some type of article about, before maybe some people were downsizing. Doesn't mean people aren't doing anymore, but actually more people are seeking greater square footage now. Okay. People want more private space. They want outdoor living. They want the home office. They're seeking amenities that maybe weren't as important for them before, right? So there's that change in the consumer preference. Now, we at Ladder and Bloom partake with some proprietary national data, and we contribute based upon our local market expertise. And what I can share with you with that is that nationwide, there is a shift towards the suburban marketplaces, okay? It basically says in the ranking, strong shift to urban, 0. Moderate shift to urban, less than 10%. Neutral meaning it's a normal market dynamic between suburban and urban is about 40%, or about 40% is neutral. Then under moderate shift to suburban is, and significant shift is 50% of the marketplace. Okay, so it doesn't mean that it's a ton of people moving out, but there are people that are now saying, I'm willing to drive more in order to get the lifestyle or the square footage or the amenities I'm looking for, whereas I might not have been as willing to before. And also, we're also seeing an uptick in the second home market, okay? For us, we service the Mississippi Gulf Coast. The number of people that, are falling back in love with the coast, right? I can speak because we actively have offices on the Mississippi Gulf Coast, but, it's taking place across the beaches. It's insanity right now. Like Orange Beach's Destin's on inventory, just like waterfront property in Bay St. Louis and Pass Christian is hitting all-time highs, right? Because people that say, hey, I live in New Orleans, but guess what? If this were to happen again, I'm not going to hang out at my place uptown. I'm going to drive to Pass Christian and be on lockdown over there. I mean, these are all real things that are affecting market dynamics right now.
Let me say this, that, there's a big debate in this country about urban and ex-urban and the extent to which ex-urban is really growing. And this is what Chip's alluding to. The question is, do people want to move to this outer ring suburbs, or are they having to move there because they can't afford anything else? And I think this aligns with the different housing typologies and what we talk about in terms of the housing middle, the missing middle in terms of housing. And New Orleans is an interesting place because it has a pretty diverse range of typologies. I see, even in New Orleans, a number of condo conversions happening, which I think is interesting. I also see a number of older condos that are essentially ripe to be torn down and be redeveloped. I think when you start looking at the broader aging society phenomenon and that second home market, which is going to drive things, there's good things about it. They're going to pay property taxes, but they're not necessarily going to bring the intellectual capital, the people you need in your workforce. So you can rely on them, but the question is, to what extent, is that a market you can fulfill your sort of urban economic development mission with? Sometimes they bring unearned income that's good for local investment and philanthropy and things like that, but it's not a long-term prospect for building out your city, particularly in a city which has huge cost burdens for New Orleans, particularly for most of the labor force, which drives the hospitality sector, among other sectors that drive. I mean, the vast majority of the economy here is driven by people who can barely afford to pay their water bill, much less their rent. So, the demand going forward, I think, is going to be for middle income and affordable housing. And that means that some of these suburbs are actually going to have to densify, and that's going to change the characterization of these suburbs, and it will have impact on preferences, because some people, as Chip said, are moving to the suburbs because they're wanting different things, they're wanting different amenities. Some people are just being forced out, and that's happened. That's been a trend that's been on par for a number of years now. So the real challenge in my mind is, okay, if it's the suburbs, and no doubt that's the case, these inner tier suburbs or suburban areas are going to have to densify pretty significantly and basically upzone. And you're going to have to upzone and downzone in the right places to guide this growth in a way that manages the land economics of it all. And no one in New Orleans particularly seems to have a good eye for how you do that.
So we have a few questions in chat, but before we get there, Dr. Keenan, you've hit on something that I've been dying to ask, even if it does seem a little out of scope. What are your thoughts on an earned income tax for Orleans Parish proper? Because, to your point of, we have aging infrastructure, we have infrastructure that costs way too much for us to support it as is today. We have folks who commute from other parishes. They earn their money here, but then they take their money back to St. Tammany. They take their money back to St. Bernard. They take their money back to Jefferson Parish. They spend it there. They pay property taxes there. So we're really losing. So what are your thoughts on an earned income tax similar to like Philadelphia as an example?
Yeah, I'd have to look into more detail. I really, before having an opinion, I'd need to really research that. My instincts are that Philadelphia and New Orleans are quite distinct for a number of reasons, and that such a tax could really kill a lot of positive momentum and among property taxpayers that you desperately need, who are willing to take the kind of property tax that's coming, by the way. So I think I'm gonna reserve my opinion on that going forward. But a number of cities, I think pied-à-terre taxes are much more effective in general in terms of non-resident owners, because the goal is to get housing units filled. And I don't really think that's a huge problem right now, but I think going forward, as you get new development and new condo development in particular, as that begins to come online, which by right now it's very small numbers, it's not even so consequential, but I think in the future it will become more consequential. It's going to be something you're going to have an eye for.
So I want to say one thing on this. I just think we always have to be careful anytime we talk about increasing taxes, okay? Whether it's at the federal level, the state level, or the local level. And, if we look at the state level, no secret, Texas, no state income tax, lived there for 5 years, right? Florida, but, people have also heard, it shouldn't be a surprise to anyone on the call, the state of Mississippi is on a path to get rid of their state income tax, right? So essentially, we could be in between two states with no state income tax several years down the line. Texas already there, Mississippi on the path for there, right? So if we still have a state income tax at the state level, and then we keep pushing more and more taxes at the local level, as what's been alluded to, that's not a good recipe, right? So, we want to be free-flowing market and have smart taxation where we need to, but we also have to walk a very careful line about not overly taxing, because sometimes people with resources that are mobile move in those situations, and that is absolutely not what we want.
Yeah,
Great
but
point.
most of the research suggests that a certain income distribution and particularly the upper 10%, they are particularly mobile at an enterprise level in terms of making decisions, and that can be make it or break it. But in general, I hear what you're saying, and I think that there's a pending. I don't know if that legislation got passed on the tax cap in Louisiana, which is kind of an illusory phenomenon relative to your federal deduction, but that kind of thing is important. But in general, the upper income decile is not particularly responsive to these types of taxes in terms of location decisions. Doesn't mean enterprises are not, but people themselves generally can bear much higher taxes, and sometimes that's what you're going to have to do. But I agree, you got to to be competitive. In these particular types of markets, taxes is critically important. And you can tax yourself to death without really spending that money on anything. And Florida is a good case because Florida doesn't have an income tax. It's great to live in Florida, but the local taxes are terrible and they're horribly misspent as a consequence because they've gutted most of the growth management. So you don't really get a lot for your tax dollars in Florida.
Jeanette, I learned this firsthand. My first job out of school, I worked for Duff & Phelps, an investment bank and financial advisory firm, and I worked in the real estate arm. So in my office in Houston, there was a tax incentive group, right? All their jobs were to go around and shop. Who's going to give the best deal? Who's going to work with them? I was like, you can do that? You know what I mean? Like that, right out of school, it's like, wow. And it was so cool and interesting. It's like, yeah, if we're bringing jobs in today's redevelopment growth, right? And so much of it is the opposite of taxation. It's like, work with us to lower it. I mean, it's got to be fair and win-win, but it's like, we're bringing these things, and me being in the office with those people gave a whole new appreciation for the work and the negotiations that take, because you basically find whether it's cities, states that are either want to play ball and they're friendly with it, or they take a stance and say, we're not doing it. Right. And then they choose their path. I'm always one where let's work a deal because, I'd rather jobs and growth coming into our region than somewhere else. And GNO Inc., Michael Heck, some of the things the state's been doing, tax incentives, all these things are positive things. And we need, just to continue to support the leadership in New Orleans Business Alliance, right? All of these groups, which we're very grateful for, just continuing to have the private sector behind it. What can we do to make that happen? And, the public sector working with the private sector money that's coming in.
Yeah, no, absolutely. As an economic developer, I'm very familiar because the incentives, like the digital media software incentive or the R&D tax credit and the angel investor tax credits, both of which were successfully extended last special session. Those are some of my top selling points when I work on attraction efforts for the bio and life sciences industry. So I completely agree. I completely get it. It also does not help. I'm going to get to these questions in the chat, I promise. But it also does not help that our state. So to your point, Chip, about being sandwiched in between other states with no personal income tax, we also have it's the highest sales tax rate in the nation, I think. And so that hits everybody, especially the folks who don't even need to worry about a 6% personal income tax. that hurts our people, but it's a huge revenue generator as well. So it's, yeah, I don't know what the answer is. Let me go to the first question very quickly. It says, I see some of Dr. Keenan's recent students in the audience today and wonder what we should be doing specifically to keep talented young professionals in the city/region. And I assume this is in the vein of, brain gain, not brain drain, and brain gain that will, generate more taxes and payroll. So any good ideas on that one?
Well, better quality multifamily, more condo development, downtown, walkable, warehouse, keep crime down.
Okay. Chip, that was a quick one. You have anything to add or just want to say ditto?
Well, I just want to say crime, people need to feel confident that we're heading in the right direction when it comes to young professionals starting their jobs or money flowing into the marketplace, right? When people aren't clear on a direction where a marketplace is headed, money stays on the sideline, right? And so do people. They don't make decisions. So if people can continue to see improvement in city services and feel as though we're heading the right direction with the police security and that crime is on the downtrend and not on the uptrend, then we're going to be in a good place because people will feel confident about staying here long term and pumping money into our city. And that's where we need to be.
Got it. Okay, next question is more broadly. It feels as if both residential and commercial real estate across sectors are as good as it gets despite the higher material costs and labor shortages plaguing the country. Jesse and Chip sound generally optimistic about the asset class on a forward-looking basis. What are the drivers that support that optimism?
So let me start on the residential side, okay? Nationally, we've read things as much as like 4 million housing units that are a shortage, right? 4.5. So and then let's look at the demand side. There is absolutely pent up demand, okay? And then we're in a low interest rate environment, right? So we've heard that for how many years now? At some point, this is not going to last, okay? But I do think that some people that understand inflation have said that, okay, I haven't made this move, but now I want to lock something in for the longer term, right? Because I know that higher interest rates are coming. It's not necessarily happening this year, but we can all agree, I can't go out right now. I can get a 15-year mortgage for about 2.25, a 30-year for 3%. If we would have said, I would have taken that bet all day long 7 years ago when I locked in at a 3.5% interest rate on 30-year mortgage, that would not be the case, right? But with these historically low rates, the demand side of the equation now, and people understanding inflation and wanting to go on hard assets, right? People that understand say, listen, I don't want to be liquid. I want to take money, put it in hard assets because I think that's going to be one of my hedges for the future. Those things are playing in. Now, I will say that once again, when I talked about like the Four Seasons, Virgin, like things that were in the pipeline come to fruition, new development is absolutely going to be more challenging over the next 12 months, right? And that's going to be one of the challenges on the residential side because some builders are like, they're still going, hey, with where my lumber is, where this is, and they know they just have to raise their prices, but some of them still aren't there. Like, how can I raise my price that much and still do it? Like some of your smaller builders that aren't like the sophisticated, like REITs, things like that. Like when I have these conversations, I'm like, just do it right now because I can tell you the demand's there, but get your product on the market like in the next year. Don't make it an 18-month build. So, but some people are also making decisions. Like I went from saying I was going to build a new house in a different location to instead I decided to renovate a house, because I got a good value on it. And, I know where lumber is and whatever. So I made a change in my preference based upon the circumstances, but I was also locking an incredible interest rate. And I said, let's roll with this. But, we do it. And there's money floating around the economy too right now, right? Whether it's like money from the past, there's federal money that's been pumped in. So all those are positive indicators, right? We all know everything cycles. But right now, this is going to continue pending some black swan event to be a strong 2021 year.
There's more money than there are assets to buy things.
Yeah.
And in New Orleans, I think for a number of different reasons, keeps people out. And I think that's probably a good thing. It probably helps stabilize the market. I think Chip said this the other day, New Orleans is not as unstable or doesn't have the same highs and lows as other markets. And I think that will inure to the long-term benefit in New Orleans in terms of relative stability. But at the end of the day, as it relates to new development and infill development, you really need a vision about where you want this infill development to go because the public infrastructure has to be able to keep up. And right now, we talk tax all we want, but it's inconsequential.
Yeah.
What's most important is how you're going to align where the development is going to go with where the infrastructure and is who's going to pay for that. Is the number one question in New Orleans. And as soon as someone can figure that out and begin to essentially manage the land economics behind that, appropriately using land use and zoning and the like, we'll be in a much better position for more sustained production of the types of units that the economy needs. Right now, no vision for that.
Thank you. And we have 1 minute, so I'm going to go ahead and just rattle off the next question. Housing costs are lower than some places, but so is the income of many of our families. About 40% of people in New Orleans are cost burdened by housing costs. What more should we be doing from a policy standpoint to make the situation better for these hardworking citizens? And again, to Chip's earlier point, these citizens are the ones who are likely supporting our hospitality industry. Any ideas on policy?
That's
Dr.
exactly
Keenan?
what I just said.
Yeah.
Right. Okay.
No.
All right.
It's controlling land and making sure that you have adequate infrastructure to support land so that you can build different types of housing configurations at different densities,
Okay.
and different types of housing typologies to support different households. Right now, we don't have enough diversity, and we don't have an infill strategy.
Got it. Are you gentlemen okay with taking one more question, or is that okay? It's 10 o'clock.
Whatever you want.
Sure.
All right, let's do it. On the utilities and water municipality note, do you expect more federal or local incentives for residents and commercial investors here to individually make homes, buildings more efficient to fight cost increases? If so, what residential and commercial infrastructure trends do you expect here in New Orleans, specifically versus other cities?
That was a lot. That was like several questions in
I
one.
know, I can go back.
No, it's okay. I mean, I'm not the policy expert, right? But like any incentives that can be created, the issue isn't on the demand side of the equation. What I do is it's on the supply side, right? So any incentives we can do to help spur development at affordable pricing helps like the people on the demand side buy. You know, what we don't need is things that further fuel like first-time buyer credits and things like that, because it's like throwing fuel on a gasoline on a fire already, right? We need things that help the development side, that get things feasible while, I guess, maintaining the cost structure and making sure people can afford it. Dr. Keenan, I don't know if you have anything else.
Yeah, I mean, on the utility front, individually, you know, the regulated circumstances associated with, you know, metering PV and solar on people's houses is kind of ridiculous in Louisiana and in New Orleans. That can help people, you know, whenever you reduce your utility costs or your electricity costs, particularly for elderly people, that, you know, has real economic benefits at a household economy level. But otherwise, that it's not the scale of the problem or the solution. It'll definitely help, and New Orleans and Louisiana needs to get their act together at the Public Service Commission in this regard. And you know, Entergy needs to put their money where their mouth is when it comes to these types of things. By the way, there's a lot to be held accountable for when it comes to energy, and we'll find out this weekend how that's going, post Texas, if you will. But nonetheless, it's not quite the scale of the problem at the household level.
Got it. Okay. And to be respectful for everyone's time, I think we're going to go ahead and end this. But there were more questions in the chat, so I apologize to the audience for not being able to get to those. Next time, put them in there earlier and we'll do it. Dr. Keenan, Mr. Gardner, this was excellent. We really appreciate your participation. We could probably go on for many more hours. So we thank you for all that you gave us in the time that you gave us. And thank you to the Urban Land Institute. And we will catch you all next time.
Thank you.
Thanks
All
for
right.
having me. Take care, everybody.
Thanks for being here, everyone. Take care.
Bye. Thank you.
Bye.